So today, we're going to break down something pretty remarkable. It's the story of a company, Willas-Array Electronics, and how they went from losing millions to making millions in just 1 year. But this isn't just a story about numbers on a spreadsheet. It's really about a very deliberate, high-stakes pivot that completely reshaped their entire business. Let's dive in and see exactly how they pulled it off. Okay, let's just start with the headline numbers because the contrast here is, well, it's staggering. Take a look. In the first half of 2024, Willas-Array was in the red, posting a loss of almost 79 million Hong Kong dollars. Fast forward just 1 year, and they've completely flipped the script to a profit of over 20 million. That is a nearly $100 million swing in just 12 months. Just incredible. All right, so a turnaround like that obviously brings up the big question. How on earth did they do it? Well, it wasn't some single silver bullet or a stroke of luck. It really came down to three key, very strategic moves that drove this new profitability. These were the three pillars of their comeback. First, and this is a big one, they dramatically improved their gross margins. Second, they managed to recover debts they had basically already written off as lost. And third, they finally sold off a bunch of old, aging inventory. Let's start with those margins, because that's where the story really gets interesting. I mean, the scale of the improvement here is just huge. Their gross profit margin more than tripled, jumping from a razor-thin 3% all the way up to 9.8%. Now, this didn't happen by accident. It was really a combination of better market pricing and a really focused, successful push to clear out all of that old inventory we just talked about. So, with profits and margins way, way up, you'd probably assume they were just selling a ton more stuff, right? Well, not exactly. And this is where the story gets a little more complicated. And honestly, it reveals what their true strategy was all along. This one number right here tells you pretty much everything you need to know about their new game plan. Despite that huge swing to profitability, their overall revenue actually dipped by 2.1%. See, they weren't just chasing growth for growth's sake. They were chasing profitable growth, even if that meant their total sales got a little smaller. So where did that new profitable focus come from? You can see the new shape of their business right here. The automotive segment is now their single largest piece of the pie, making up almost 29% of their total revenue. And let me tell you, that shift wasn't an accident. It was a very deliberate, strategic choice, and it was clearly paying off. And the story gets even clearer when you look at the year-over-year change. While their key automotive segment grew by over 8%, other areas like audio and video dropped a lot. And according to their own report, this was a conscious choice. They were proactively getting out of low-margin business specifically to boost their bottom line. It's a classic case of addition by subtraction. So the performance is impressive, no doubt. But is it built on a solid foundation? To see if the company is actually healthier overall, we gotta pop the hood and do a quick health check on their finances. A really crucial health indicator for any company is its debt. Their net gearing ratio, which is basically just a measure of debt against equity, saw this huge improvement, dropping from almost 140% down to about 105%. And with this metric, a lower number is always better. It means the company is way less reliant on borrowed money, which makes it financially much more resilient to any future shocks. Another key sign of a healthy business is just how efficient it is. They managed to improve their inventory turnover, which means they now sell through all their stock in just 2 months, down from 2.2. Now, that might seem like a tiny change, but in a business of this scale, it's absolutely critical. It frees up cash that would otherwise just be sitting in a warehouse, and it lowers the risk of products becoming obsolete. This might be the most powerful number of all, the actual cash generated from their core business. The swing is just massive. They went from burning through over $70 million to generating nearly $220 million in cold, hard cash. This proves the profit isn't just some accounting trick, it's real money flowing into the company. And that, as we all know, is the lifeblood of any business. Okay, so they've stabilized the ship, they're profitable, and they're generating a ton of cash. The crucial question now becomes, how do they keep this momentum going? Well, the company has laid out a pretty clear 5-point strategy for what's next. Their game plan really shows they're doubling down on what's been working. They are focusing intensely on the electric vehicle or EV market as their new growth engine. They're also aiming to build on their leadership in automotive and audio, launch a new platform to help their clients, and use data to be way more selective about who they partner with. In short,
It's a strategy built completely around focus and profitability.
And that brings us to our final question. Willas-Array has engineered a truly impressive turnaround by focusing on high-margin sectors, especially that booming EV market. They've cleaned up their books and have a clear strategy. But as their own report points out, they're operating in a world with ongoing US-China trade tensions and a lot of market uncertainty. So the big question remains, is this brilliant strategic pivot enough to make sure their turnaround isn't just a temporary fix, but a truly sustainable success story?